Hi, this is Doug Johnson, HCM Senior Investment Strategist, and I'd like to welcome you to the market update. As a quick reminder, this is the executive summary version of this presentation, so it will only be 2 slides covering the main bullet points, and we'll target for about 5 to 10 minutes here. But if you would like to listen to a more detailed and longer version of this, we will have that available on the website here in the next day or so. So let's get started. As you may know, with the volatility that we've seen in the market over the past month and a half, we have made the decision to reduce our equity targets by 20% from neutral. So for example, if your neutral model weight was 60% equities, it's now been reduced to 40%. Extreme volatility that we've seen has resulted in the worst first quarter for the S&P 500 on record. Sectors that have been performing well relative to the rest of the market, technology, healthcare, and staples, while things like energy and financials were the worst performers. Not completely surprising in a market that's been very heavily weighed to the downside. International positioning remains slightly underweight versus the U.S. The virus has truly gone global, so we don't think that there's any one region that's going to be spared from this. Unfortunately, we came into this with a little bit of an underweight to international, which we had been a little bit more optimistic about when the phase 1 China deal was reached. But the coronavirus has kind of undone all of that, and we will remain slightly underweight international for the time being. On the fixed income side, our portfolio duration remains slightly below what the benchmark levels would be. As a reminder, duration is just a fancy way to describe the relationship between interest rate movements and bond prices. So if you have a portfolio with a duration of 5, interest rates go up 1%, the price of that bond should go down 5% and vice versa. So as we look at what the positioning of our fixed income looks like, the core positions have held up well throughout this, particularly the ag-like positions or the treasury positions have really held their own and in fact gained slightly throughout this. While the spread sectors have certainly underperformed, things like high yield, emerging market, and credit. We've also seen some wide dislocations in the municipal market. We've seen yields pushed at a high point 250% above what a normal treasury yield would be, which is a very, very unusual situation. To see that in the muni market, I think there is some concern going forward about an extremely slow economy and how that would relate to states and municipalities being able to collect tax revenue. But for the time being, we think that the muni market will settle down a little bit, and that differential between the yields should shrink. Rates are expected to remain low for the duration of the crisis. The Fed's cut the Fed funds rate back to 0 effectively. They're performing unlimited quantitative easing right now in order to keep rates as low as possible to help stem some of the economic destruction that we've seen during this crisis. So global growth forecasts have essentially collapsed as measures to contain the virus have increased, which has essentially shut economies down throughout the world. A U.S. recession is extremely likely, with only the severity and the duration yet to be determined. You're seeing some comparisons to the possibility of a recession versus depression, but I think the consensus has certainly shifted to the realization that we actually are currently in a recession, And the question is, how long is it going to last? Inflation remains extremely low, though concerns about future increases have resurfaced. And this has come in the face of, basically extraordinary levels of stimulus, both from a fiscal and a monetary standpoint. The Fed's balance sheet has ballooned to close to $6 trillion. You've had the government already pass a $2.5 trillion stimulus plan with plans for another $2 trillion coming very shortly. So as all of that stimulus and all that money is injected into the system, there certainly would be concerns that eventually you would see some inflationary pressures. But for the time being, we don't see any of those popping up. So political issues have pretty much taken a back seat with the election, almost an afterthought for the time being. We would expect, as the virus news dies down, if it does, that this would pick back up. But for the time being, it's really become a non-factor in the daily news flow. So what are the main risks that we see going forward? Obviously, if the U.S. recession were to turn into a depressionary scenario, if the virus isn't contained, or if the containment measures that we're taking continue to put pressure on the economy going forward. Additional downward pressure on stock prices as companies report earnings and guidance that, quite frankly, is well below what the initial estimates were. I think on the whole, earnings estimates going forward are still very optimistic in the face of what's going on. If those get reduced further, or if they come in much lower than expected, it could cause a significant repricing lower in stocks. So the loss in the belief that central bank stimulus can provide significant support for the markets. I don't know if it's a coincidence, but the initial bottoming process for this sell-off happened to be the day after the Federal Reserve announced their unlimited quantitative easing program. And I think that over the past 11 years, investors have gotten comfortable with the fact that if something goes wrong, the Fed is going to step in and do something to kind of save the day, so to speak. And we've talked a little bit about, if that belief were to fall or go away, what that would mean for markets. Now, I think that they're probably reaching the point of their powers, so to speak. So we're close to central banks really being truly all in on trying to do what they can to stem this tide. And if that confidence goes away, that they've lost the ability to provide support, it could spiral out of control very quickly. And then lastly would be any kind of unexpected increase in inflation. Again, we're not seeing any inflationary pressures right now, but if you did see some, or anything that would cause rates to rise rapidly, I think that would put certainly stress on the credit markets, but I also think it would put stress on the equity markets as well, as kind of a further unexpected shock. So just as a reminder, again, we do have a longer version of this presentation that provides more detail. It has some more graphs and information in it. So if you're interested in that, I would welcome you to take the time and find that on our website. If not, I want to thank you for joining us today. And as always, if you have any further questions or comments, please reach out to your advisor.